Have you ever noticed that every time people start talking about building wealth, the conversation almost always ends with the same argument? Someone says buying real estate is the smartest investment you'll ever make, while someone else says you're wasting your time because investing in the stock market beats real estate over the long run. Both sides sound confident, both use impressive numbers, and both claim the math proves they're right, but here's the problem. Most of those comparisons leave out the most important numbers. And when you ignore even one major expense, the entire conclusion can change. So instead of choosing a side, we're going to run the numbers from start to finish using one realistic scenario. Because real wealth isn't built by opinions, it's built by understanding the math behind every financial decision. Before we begin, here's a quick disclaimer. Wealth Horizon creates content for educational and informational purposes only. Nothing in this video should be considered financial, investment, tax, or legal advice. Now let's begin. Imagine two friends named Jake and Marcus. They're both 30 years old, both earn $100,000 a year, both have stable jobs, similar lifestyles, similar monthly expenses, and after years of saving, they've each managed to build a $100,000 investment fund. Neither one is lucky, neither one inherited money, and neither one knows what the future holds. Jake has always believed that owning real estate is the fastest path to becoming wealthy. He loves the idea of owning something physical, collecting rent every month, and watching property values rise over time. Marcus thinks differently. He believes businesses create wealth, and instead of buying a house, he invests every dollar into a low-cost S&P 500 index fund that owns shares in hundreds of America's largest companies. At first glance, Jake appears to have the advantage because he uses his $100,000 as a 20% down payment on a $500,000 rental property. The remaining $400,000 comes from a mortgage, which means Jake now controls a $500,000 asset while only investing $100,000 of his own money. This is called leverage, and it's one of the biggest reasons real estate has created so many millionaires. If that property increases in value by just 5% during the first year, its market value rises by $25,000. Jake didn't invest another $25,000, yet his equity still grows because he's controlling a much larger asset than the cash he originally invested. Now compare that with Marcus. He doesn't borrow money, he doesn't sign mortgage papers, and he doesn't spend weekends looking at houses. Instead, he invests his entire $100,000 into an index fund. His investment simply follows the performance of hundreds of businesses that continue selling products and services every single day, whether he's sleeping, traveling, or spending time with his family. Mortgage interest, property taxes, homeowners insurance, maintenance, repairs, vacancies, management fees, closing costs, and unexpected emergencies all become part of Jake's financial journey, while Marcus faces an entirely different set of risks that most investors underestimate. So before we decide who's actually making the better investment, we need to calculate every dollar that enters and leaves their pocket. Because once we include the hidden costs that almost everyone ignores, this debate starts looking completely different. Then come property taxes, homeowners insurance, routine maintenance, landscaping, small repairs, and eventually bigger expenses like replacing a roof, upgrading an HVAC system, or fixing plumbing problems. Jake can physically drive past his property, see tenants living there, collect rent, and feel like he's making progress even during a slow market. Marcus opens an app and sometimes sees nothing except a sea of red numbers during a market crash. Ironically, both investments usually reward patience, but they test that patience in completely different ways. Real estate challenges your cash flow while stocks challenge your emotions, and history has shown that emotions often become an investor's biggest expense. Now let's look at something almost nobody includes in online comparisons: the opportunity cost of that $100,000. By putting all of his savings into the down payment, Jake immediately reduces his liquidity. Let's assume both investments perform reasonably well over the next 5 years. Jake benefits from rental income, gradual loan repayment, and property appreciation, while Marcus benefits from business growth, dividends being reinvested, and long-term market appreciation. At this point, you might be thinking the stock market sounds safer, but that's only part of the story because real estate has one powerful advantage we still haven't measured correctly. Every monthly mortgage payment slowly increases Jake's ownership in the property. Even if home prices stayed completely flat for years, part of each payment gradually builds equity by reducing the loan balance. The question now isn't which investment grows faster. The real question is which investor actually ends up with the higher net worth, after accounting for appreciation, cash flow, taxes, expenses, inflation, and the value of time itself. Because once those numbers are combined into one complete picture, the answer becomes much more interesting than most headlines would hate. None of those problems made him rich overnight, but they also didn't stop him from gradually building equity. Every payment reduced a little more of the loan balance, and every year of appreciation increased the property's value. Slowly, without attracting much attention, his net worth continued growing. Marcus experienced a completely different journey. During those same 10 years, the stock market didn't move in a straight line. There were exciting bull markets that made investing feel easy, but there were also corrections that erased months of gains in just a few weeks. Headlines predicted crashes, recessions, inflation, and financial disasters almost every year. Friends told him to sell. Social media claimed the market was finished. Yet Marcus kept investing consistently instead of reacting emotionally because he understood one simple principle. Jake and Marcus are now 50 years old and both have remained remarkably disciplined. That consistency turns out to be one of the biggest reasons both have built meaningful wealth, because successful investing is usually less about finding the perfect investment and more about sticking with a reasonable strategy for a very long time. On paper, Jake looks like a successful real estate investor, and by most standards, he absolutely is. Marcus has experienced a different kind of growth. His portfolio has survived market crashes, economic uncertainty, rising interest rates, political changes, and periods when financial news predicted disaster almost every week. Now here's the surprising part. When financial researchers compare long-term investing, the answer isn't as simple as saying stocks always win or real estate always wins. The outcome depends on variables such as location, purchase price, financing terms, investment costs, rental demand, market performance, taxes, and most importantly, investor behavior. When you remove those real-world factors, every investment looks better than it actually is. The real lesson isn't that one investment defeats the other. The real lesson is that wealth is rarely created by choosing sides. It's created by understanding how each investment works, recognizing its strengths and weaknesses, and selecting the strategy that matches your financial goals. At this point, one question still remains. If the goal isn't choosing between real estate and stocks, then what should someone actually focus on first? The answer has nothing to do with picking a winning asset and everything to do with building a financial foundation that allows any investment strategy to succeed. If you've been waiting for this video to declare one clear winner, you might be disappointed, because the biggest takeaway isn't that real estate beats stocks or that stocks beat real estate. Think about Jake and Marcus one last time. 20 years ago, they started with exactly the same amount of money. Neither one had special advantages. Neither one had insider knowledge. They simply committed to different paths and stayed disciplined. Jake accepted the responsibilities that came with owning property. Marcus accepted the volatility that came with owning businesses through the stock market. Both experienced setbacks. Both questioned their decisions during difficult periods. Both had moments when it seemed like the other person had chosen the better investment. If this video helped you look beyond the headlines and understand the real math behind one of personal finance's biggest debates, consider subscribing to Wealth Horizon for more educational content that breaks down complex financial topics into simple, practical insights. Every video on this channel is designed to help you become a more informed decision maker, not by telling you what to buy, but by helping you understand how money really works. Remember, wealth isn't built by chasing every opportunity. Thanks for watching Wealth Horizon, and I'll see you in the next one.